This is the last session of the day. We continue with our general theme of retirement debt and financial fragility at old ages. And our first paper will be Lori Trowinski, who will be talking about older Americans and the mortgage market crisis, an update.
Good afternoon. Thanks. I'm just checking how many people had the gigantic pretzel snack and whether you're still with us. So thank you very much for still being here. I want to thank Anna Maria and Olivia, especially Olivia, for her very strong invitation to update my earlier paper from 2012. And one point I would like to make up front, you will not see any data on the elderly in this presentation, and that is because at AARP we have older Americans, but not the elderly. You'll also not see anything about gray debt, because as I can demonstrate, hair color has been invented, and many of us avail ourselves of it. So, you might be wondering, why are we having a discussion of foreclosure in 2019? And you would be thinking that because, well, by golly, the economy has improved since the last time we visited this topic, or at least I visited it in 2012. Unemployment has fallen to its lowest level in decades, and home values have risen. So why do we want to look at this? Well, I'm happy to present today data from 2012 through 2017, and what we'd like to look at is whether we can determine from mortgage performance if the benefits and the improvements in the economy have been true for borrowers of all ages. But there's another reason to look at foreclosure today, and we've already heard a lot about this morning. As you know, mortgage debt incidence is increasing for borrowers of older ages. So this data is SCF data showing us that the percentage of families carrying mortgage debt at older ages is increasing. The line on the bottom, the yellow line, are people headed by, households headed by someone 75 or older. And the line above it, which coincidentally appears gray, but not on purpose, is also increasing. And just to give you a sense of what the actual numbers are, for people age 75 and older, the percent of families carrying this mortgage debt more than tripled. And so now 27% as of 2016 had mortgage debt at the age of 75 or older. And the other piece of the story is the amount of the debt is also increasing. So this is a look at the median mortgage debt by age. And so that has increased. So we have more older families carrying mortgage debt and higher amounts of debt. So the other thing I want to point out about this mortgage debt is that it doesn't necessarily reflect older people buying larger homes. It can reflect people who chose to refinance and take cash out for other purposes. We often hear that people make the decision to pay off credit card debt with mortgage debt. Now, while we don't recommend trading unsecured debt for secure debt, many people do this. Another thing it could reflect most certainly is student loan debt, but again, we are not able to identify exactly what people are doing when they do take cash out of their mortgage. But what I will say is that for some people, this kind of situation can be a recipe for financial disaster. Many people face a reduction in income upon entering their retirement years. Many have not accumulated adequate savings to support themselves for 30 years of potential longevity. And many are not planning ahead for the increasing medical costs that many will face or accounting for inflation. And many are also unprepared for the death of a spouse, which often also leads to a great decrease in the amount of household income. And while it's true that home prices have risen since the Great Recession, it's not true for every area of the country. There are still some areas that are below their peak price levels, and other areas have faced some really catastrophic natural disasters. So we are seeing increasing foreclosures as a result of floods, hurricanes, tornadoes, and fires. And one final point. While home prices have increased for many borrowers, you still have to be able to pay the mortgage. And so a higher home value does not necessarily equate to the ability to borrow against accumulated equity. It really depends on the amount of any existing mortgage, credit scores, and income. And so it's more complicated than just looking at housing wealth and saying, oh, these people will be fine. So now I want to talk quickly about the data that I'm looking at. So we worked with CoreLogic to get a very unique data set. What they did is they took loan level data based on property addresses that have mortgages across the country. They merged it with a demographic data set and identified people by age at the time the home was purchased or at the time of the last sale of the home. And what they then did is matched it with loan servicing data that they collect from loan servicers. So the data represent a portion of outstanding first lien loans. It doesn't represent all of them, and it does not include any Fannie Mae and Freddie Mac serviced loans. It also is only forward loans and only first lien. So no reverse mortgages are in this data set. The data represent a snapshot as of December 31st each year, and some states actually have very short foreclosure timelines, and so it is possible that someone could go into foreclosure in January and be out of the house by December, and we would not have measured that foreclosure. And the other thing is, the way we define foreclosure in this paper is loans in the foreclosure process. So it's not a look at foreclosure starts, and it's not any real estate owned properties, because technically speaking, they're out of foreclosure because the bank has taken back ownership of the property. So that said, the data that I looked at still included over 12 million loans. So I wanted to show this graph because this is where my paper ended in 2012. It was a pretty bleak picture. This was all loans, so it included prime and subprime loans. And what we were able to see there is that people ages 75 plus had higher foreclosure rates than the rest of the borrowers in the over 50 category. So I looked at 50 to 64 and 50 to 64 and 65 to 74. And so at that time, the 75 plus had the highest rate. So now let's look at the data through 2017. So we might take a quick look at this and say, well gosh, things are so much better than they were. And in the aggregate, they are certainly better. But what is troubling is that the purple line, which represents the foreclosure rate of people 75 plus, is actually higher than all other age groups, even the under 50. Now, in the prior graph, the under age 50 folks actually had higher foreclosure rates than older people. Now, you would have expected this because they would have had less equity in their homes and probably less able to deal with the financial crisis. But now today, foreclosure rates for the 350 plus age groups are still slightly higher, ever so slightly higher than they were in 07. But for the under 50, it's actually the same as it was in 2007. So I would be hesitant at this moment to say things are pretty good for the 75 plus. And there's always more to the story than the aggregate picture will show. So the other thing that we looked at, when I say we, I mean me, myself, and I, as the sole author of the paper. I should have disclosed that earlier. But serious delinquency rates, which are for loans that are 90 or more days delinquent, They have also improved since 2007, but you will note that there was an increase from 2016 to 2017, and that's across all age groups. But for me, I also like to look at the type of loan that we're talking about. So if you look at prime loans, you'll see that things are certainly better than they were. And the red is the 90-day delinquency, the blue is the 90-plus day delinquency. And so taken together, it gives you a picture of sort of where things are going. Often 90-plus day delinquency loans end up in foreclosure. And so it's a good number, a good measure to look at to get a sense of where things may ultimately end up. So we have still, like I said, a number, a fair amount, a fairly high percentage of these loans still not performing very well, and it's still certainly higher than it was in 2007 for the over 50 group. But I think a bigger story remains with subprime loans. So subprime loans were originally designed for borrowers with low credit scores, and they typically featured higher interest rates and high fees. But as time went on, they really evolved into something else, and they often became loans with pretty anti-consumer features, things like negative amortization or pay what you feel like loans, or let's not ask what your income looks like, or better yet, why don't you just lie and we'll give you the money anyway. So the subprime loans originally were meant to help people with lower credit scores. Ultimately, I believe they ended up hurting people across the income spectrum. And in my 2012 paper, you will see that it was also communities of color that were most harmed by the subprime crisis. So interestingly, if you look at the data today, you will still see that subprime loan performance is far worse than prime loans, as one would expect. And one thing that I found really interesting, in 2017, the Mortgage Bankers Association stopped collecting subprime loan data separate from prime loan data because they said there's no need to separate it, and there's really not that many loans being made. But I think this is really a mistake, because when we cloud the data by merging the two together, we lose the detail of what's really going on in the underlying subprime sector. So for my data, I found there are still over 2 million subprime loans outstanding, and that 250,000 of those were made between 2011 and 2017. So if you thought the loans weren't happening, they still are, and from my perspective, I think it's something that we still should be looking at. So that's the quick update to what I found. What I plan to do going forward is to update my data by race and ethnicity, and also look at the income levels of borrowers, because I had done that previously. The other thing I would like to look at is what loans are in distress by origination year. So I'm now out of time, but I just wanted to point out that there are two other kinds of foreclosures that happen that are not included in my data, and that also affect the older population. One is tax lien foreclosures. This can happen whether you have a mortgage or not, but if you don't pay your property taxes, local authorities can put a lien on your property. The lien can then be sold to investors who can then force you into foreclosure. We have heard of situations where people have lost their homes over a balance of $8.41. So in some areas of the country, there are protections, but any accumulated equity you may have can also be wiped out. And then the other is reverse mortgage foreclosures. And even though these loans were designed to help people age in place, we're still seeing a high volume of foreclosures for people who have failed to pay their property taxes or homeowners insurance. And in addition, you can also go into foreclosure for failure to return an occupancy certificate or failure to maintain the home. And so once these loans go into foreclosure, it's very difficult for most older borrowers to find help in time so that they can still save their home. So, and I will be doing some future research on reverse mortgage foreclosures. So anyway, I would like to thank you all for your attention, and if you have any questions, feel free to email me. And one other plug I would like to make is the Public Policy Institute at AARP will be releasing a couple of student loan papers in the coming weeks. The first one will look at the landscape of student loan debt for the 50+, talk about a lot of the issues that we've covered here today. A second paper will look at college costs across generations, in addition to looking at the implications for future financial security of student loan borrowers today. So thanks very much.